You are 23 years old. You make $31,000 a year. Your checking account has $847 in it, and your savings account has nothing, because 3 months ago you moved it all to cover a transmission repair on a car you still owe $6,000 on. The medical bill is for $912. It arrived on a Tuesday. You read it twice. You set it on the counter. You made coffee. You read it a third time. This is the moment, not a montage, not a turning point you recognize while it is happening. Just a Tuesday in October, 23 years old, negative $65 away from zero, staring at a number that is larger than everything you have. You do not panic. You do something smaller and more dangerous. You get very quiet. You have been quiet before, when your hours got cut at the last job, when your roommate moved out 4 months early, when you realized the degree you finished was not going to do what you were told it would do. Quiet is how you survive moments you do not have language for yet. But this Tuesday is different. This Tuesday you open a browser tab you have never opened before. You type in 3 words, how money works. What comes back is noise, influencers, courses, people selling certainty. You close most of it, but one thing stays, a forum thread written in plain language by someone explaining the difference between a W-2 and a 1099, between earned income and unearned income, between money that comes from your time and money that comes from something you own. You read it 4 times. You do not understand all of it, but you understand enough to feel something shift, not hope, something older than hope, recognition. You call the hospital billing department the next morning. You ask if they have a payment plan. They do, $47 a month for 24 months. You give them your debit card number. You hang up. You still have $800. The crisis did not disappear. It got scheduled. There is a difference. The job you have now is in freight logistics. You enter data into a system that tracks invoices for shipping containers. You sit at a desk with no window. You make $15.30 an hour. Your manager is 26 years old and talks about his boat. You have learned to stop listening to the boat. But you have also started listening to everything else. The invoices you track, the route patterns, which carriers get used most, which regions have the highest volume, which clients pay late and why. You are not supposed to care about any of this. Your job is to enter the numbers accurately and move to the next row. You enter the numbers. You also start writing things down in a notebook, not because you have a plan, because you are trying to understand the terrain. 3 months after the medical bill, you open a brokerage account. You fund it with $200. This is not a significant moment in the history of finance, but it is significant in yours. You buy fractional shares of a total market index fund, the kind that holds thousands of companies in one instrument, the kind that over the last century has returned an average of roughly 10% per year, not every year, not smoothly, but across time, through crashes and corrections and wars and pandemics, the average holds. $200 at 10% annual growth, compounded, is not going to change your life in year 1. You know this. You are not here for year 1. You are here because you read something in that forum thread that landed quietly and stayed. The person who wins is not the smartest person in the room. It is the person who starts the longest compounding window possible and does not close it. You do not close it. 6 months in, you are contributing $80 a month. You adjusted your grocery spending. You canceled 2 subscriptions. You work 1 Saturday a month doing contract data entry for a different company. You found the work on a freelance platform. That Saturday pays you $112. 80 of it goes to the brokerage. Your balance at month 8 is $640. You have contributed $560 of your own money. The rest is market return. Not enough to feel, enough to track. Your manager at the freight company leaves. The new manager is different. She asks questions. She notices that your invoice error rate is the lowest on the team. She asks how. You explain the system you built, a secondary checklist you run before submitting each batch. It takes 11 minutes per shift. It catches 3 categories of error that the software does not flag automatically. She asks if you can train the other 3 analysts. You say yes. 3 months later, you are a senior data analyst. Your salary is $41,200 a year. The title is slightly misleading, but the number is real. You increase your monthly contribution to $160. You open a Roth IRA alongside the brokerage account. You fund it separately. The Roth has a contribution limit, $6,700 per year. You cannot hit that number yet, but you can aim at it from below. By month 18, your combined accounts hold $4,300. The market has gone down twice since you opened the account. Both times you watched the number drop. Both times you did nothing. not because you were calm, because you had read enough to know that selling into a loss converts a temporary decline into a permanent one. You held, the market recovered, you kept contributing. This is the first real discipline you built, not intelligence, not strategy, the ability to watch something you care about lose value and not move. Year 2, you are 25. You take a second job on evenings, not every evening, 3 per week. You work for a food delivery platform. You make between $18 and $22 per hour after expenses, depending on the night. You do this for 9 months. You do not enjoy it. You develop a lower back issue from the driving. You see a physical therapist 6 times. You stop the delivery work. You have saved an additional $8,400. It is sitting in a high-yield savings account at 4.6% interest. You have a conversation with yourself that is not comfortable. You have been contributing to index funds. You understand passive, long-term market investing. But at 25, with $12,000 in combined accounts, you are moving too slowly to build the kind of asset base that generates meaningful passive income within a relevant time horizon. Not impossible, just slow. This is not despair. This is arithmetic, and arithmetic can be changed by changing the inputs. You spend 4 months reading about real estate, not luxury flipping, not short-term rentals, long-term residential rentals, single-family homes in markets where the price-to-rent ratio makes the math work, where a property-generating rent can cover the mortgage, taxes, insurance, and maintenance with something left over. You read case studies. You read failure stories. You read about what goes wrong, bad tenants, deferred maintenance, vacancy months, property managers who disappear. You are not romanticizing this. You are building a map. At 26, your salary has been raised again, $48,000. You have switched companies. The new role is operations analyst at a mid-sized supply chain firm. The commute is longer. The work is harder. The increase was $8,000. You took it. Your combined investable assets are now $22,000, not enough for a down payment in most markets. But you have been watching one market specifically, a secondary city in the Midwest, a metro area with stable employment base, a university, a hospital system, and a median home price of $162,000. You talk to a mortgage broker. A conventional loan on a $160,000 property requires 3.5% down for an FHA loan. That is $5,600, plus closing costs of approximately $4,000. You have enough, barely. You also have an uncomfortable decision to make. The $22,000 you have saved is in accounts that are growing. If you pull from them for the down payment, you are interrupting compounding. You are also taking on debt, a mortgage, $154,000 of it, at 6.8% interest, on a property you have never seen in person. You fly out for a weekend. You walk through 4 properties. One of them is a 1986 ranch house. 3 bedrooms, 1.5 baths, a finished basement, a furnace that is 7 years old. The inspector you hire, $350, finds 2 issues, an aging water heater and a small section of the roof needing repair within 2 years. You negotiate. The seller drops the price by $4,000 and agrees to a credit for the roof. You close at $157,000. Your mortgage payment is $912 per month, the same number as the medical bill. You do not think this is a coincidence. You think it is just a number, but you remember it. You rent the property immediately. A family, 2 adults, 1 child. They sign a 12-month lease at $1,300 per month. Your net cash flow after mortgage, taxes, insurance, and a reserve fund you set aside for maintenance is $91 per month. This is not significant income. What is significant is this: someone else is now paying down your mortgage principal every month. The loan balance is declining. The property may be appreciating. And you are learning, in real time, what it means to own an asset instead of only a paycheck. At 27, the tenant breaks the lease early. They have a family emergency. They give you 60 days notice. You want to be angry. You are not. You are inconvenienced, and there is a difference. You find a new tenant in 38 days. The gap costs you about $900 in lost rent and a small cleaning expense. You had the reserve fund. It covers it. The system held. You are also watching something at work. The operations firm you work for has a vendor, a logistics technology company, private, Series B, growing fast. You hear about it in meetings. You see the contracts. You understand the problem they are solving because you have been inside that problem for 4 years. Private equity is not accessible the way public markets are, but accredited investor status, which requires either a net worth over $1 million excluding your primary residence or an income over $200,000 for 2 consecutive years, is a real threshold, and you are not there yet. But there are other doors: equity crowdfunding platforms, secondary market platforms where early investors sometimes sell shares before a company goes public. You find a position available in the secondary market, 40 shares of the logistics company at $1,100 per share, $44,000. You do not have $44,000 in liquid assets. But you have a HELOC, a home equity line of credit on the rental property. You have built equity. You qualify for a line of approximately $28,000. You take it. You combine it with brokerage proceeds. You liquidate, something you told yourself you would not do. You buy 26 shares at $1,100, $28,600. You hold it in a custodian account. This is the decision you will not explain to everyone, not because it was reckless, because it was calculated in a way that looks reckless from the outside. You understood the company. You had seen its contracts. You knew its clients. You were not trading on inside information. You were not an insider. You held no restricted stock. You had no material non-public information. But you had context that most retail investors did not have. You used it. You are 28. Your salary is $61,000. You have the rental property, a recovering brokerage account, a Roth IRA, and 26 shares of a private company. Your net worth on paper is somewhere around $140,000, depending on how you value the private shares. The back of your mind holds a number, not a goal, a threshold, the point at which the assets start doing more work than you are. You do not reach it this year. Year 28 is also the year you stop sleeping well, not dramatically, gradually. You notice it in the way you process conversations at work. You are slower. You miss a detail on a vendor contract that costs the company $11,000. Your manager is not cruel about it, but you understand what it means. You are carrying too much. The rental property, the investments, the secondary market position, all of it lives in the part of your mind that is supposed to go quiet at night. It does not go quiet. You make an adjustment. You hire a property management company, 8% of monthly rent, $96 per month. Your cash flow drops to negative $5 per month. You are now losing $5 on the property technically, but you sleep for the first time in 4 months, and you understand something about optimization that the spreadsheets do not capture. A system you can maintain indefinitely is worth more than a system that returns slightly more and eventually collapses you. At 29, the logistics company announces a late-stage funding round. The valuation has increased. Your 26 shares, purchased at $1,100 each, are now worth approximately $3,100 each. On paper, the shares are still private. You cannot sell them yet, but the number is there, $80,600 on $28,600 invested in 18 months. You do not celebrate. You have learned enough to know that paper gains are not realized gains. You have also learned something about yourself. The feeling you expected, relief, joy, some sense of arrival, is not there. What is there is attention, the same quiet attention you brought to the freight invoices. You are watching. 30 years old, the company goes public, not a blockbuster IPO, a quiet one. The stock opens at $28. It closes its first week at $33. You sell 20 of your 26 shares over the following 6 weeks. After taxes, long-term capital gains rate, because you held longer than a year, you net approximately $51,000. You keep 6 shares, you let them ride. You pay off the HELOC fully. You reinvest $30,000 into index funds. You use the remaining balance to fund a second property acquisition, this time a duplex. One unit rents for $850, the other rents for $900. Your mortgage is $1,310 per month. The duplex cash flows. You have a property management company on it from day one. At 31, your net worth crosses $300,000. You are still employed. You are still contributing to your Roth IRA every year. You have not started a company. You have not found a mentor. You have not gone viral. You have done, repeatedly, the same set of boring decisions that compound into something that does not look boring from a distance. You get the accredited investor designation at 32. Your income has reached $220,000. You moved into a director-level operations role. The title took 5 years longer than you wanted. It arrived exactly when the other pieces were ready to receive it. With accredited status, new doors open. You begin putting $10,000 per year into a private equity fund, a real estate syndication focused on multifamily properties in Sun Belt markets. You are not the operator. You are a limited partner. You provide capital. The general partner manages. Your preferred return is 8% annually. Any profits above that are split. You are not building these deals. You are buying into the carry of people who are. 34. Your net worth crosses 7 figures on a Wednesday morning. You are sitting at your kitchen table. The coffee is still hot. The market opens in 47 minutes. You look at the number on your screen for a long time. You do not call anyone's. Not because you have no one to call, Because you have learned that this number, the one you crossed, the one that sounds like something, is a threshold, not a destination. On the other side of $1 million is not safety. On the other side is a different quality of risk, a different tax structure, a different set of decisions you are not yet fully prepared to make. You close the laptop, you get dressed, you go to work. The properties generate income now, not enough to retire on, not yet, but enough that if you stopped working tomorrow, the assets would slow the decline. The index funds are worth $412,000. The real estate portfolio, 2 single-family rentals and a duplex, has a combined equity position of approximately $380,000, accounting for current market valuations and outstanding mortgage balances. The private equity positions are illiquid but performing. The 6 shares you kept from the logistics company are worth something you check less often now. Checking frequently stopped feeling useful around year 3. You are 35, you have not told your family the number, not because you are ashamed, because the number is not the story. The story is the Tuesday, the $912 bill, the forum thread, the decision to start a compounding window when you had $200 and no margin. Most people who get to a similar position from a similar start made one decision you also made. They treated money as a system to be learned, not a mystery to be survived. They stopped performing helplessness and started performing literacy. That transition is not comfortable. It costs something. Sleep, usually. Relationships, sometimes. The version of yourself that could afford to not know. You have filed that cost away. You do not regret it. You are not sure regret is available to you anymore, not in the way it once was. What you have instead is clarity, about what you traded and what you received, about what is still unresolved. Because some of it is still unresolved. The private equity fund has a 7-year lockup. You will not see those returns until you are 39 at the earliest. One of the rental properties has a tenant who pays late, not delinquent, just late, the 3rd of the month instead of the 1st. The property manager handles it, but you know, and you wonder about the roof, the original one on the 1986 ranch house, which the current inspection says has perhaps 3 years left. You are budgeting for it. But budgeting for a future cost is not the same as the cost not existing. The market opens in 6 hours and 14 minutes. You do not know what it will do. Nobody does. What you know is that somewhere below you in the system, in the freight logistics offices, in the windowless rooms, in the Tuesday moments, someone is reading a forum thread for the first time. Someone is opening a brokerage account with $200. Someone is running a secondary checklist on their invoices that their manager has not noticed yet. They are 11 years behind where you are now. They are also exactly where you were. The game does not end when you cross the threshold. It resets at a higher altitude, with different weather, and the same basic question: how much of what you have built can you keep building before something you did not model arrives and asks what you are made of? You already know the answer. You learned it on a Tuesday in October, 23 years old, $847 to your name. You did not stop